Ladies and gentlemen, to make better decisions and capture opportunities, businesses need to stay informed of the macroeconomic trends. And our 2024 macroeconomic outlook will be presented by UOB's economists and market research team. So please join me in welcoming them on stage. First to take the stage, we have Mr. Suan Teck Kin, Head of Research. We also have Mr. Peter Chia, Senior FX Strategist. And last but certainly not the least, Mr. Victor Yong, Interest Rate Strategist. Gentlemen, whenever you're ready, the stage is all yours. Take it away.
Right, thank you, Charmaine. Good morning, DPM. Good morning, Mr. Wee and Fred. Good morning, ladies and gentlemen and distinguished guests. Very happy to be here, very honored. Just now, you heard DPM talk about these various topics ended on a very hopeful note and very insightful note as well, right? So in this session, my colleagues and I will be sharing with you some of these different segments, different areas that we should pay attention to as well. Just now, DPM Heng talked about mentioned to us, right, productivity, risk management, very important, risk management, and also opportunities, whether in China or in ASEAN. Right, so I will share a bit with you some of these opportunities and also risks. My colleague will share more with you some other areas as well. Right, my name is Teck Kin. I will be sharing with you first on the macro view for this coming year. Some of the areas. The job is much easier for me now because Mr. Heng already, both Mr. Hengs already mentioned about this area earlier this morning. All right, so without much, because of the time, I'll just quickly go through some of the areas that we need to watch for this year. And in your business decisions, I think we're already quite familiar with some of these things. I just want to point out some of the smaller details. For example, geopolitical risk, we all know, right? And also we have the central bank making decisions that will affect us all this time, and China's economic recovery, and also electoral landscape that this morning DPM has also covered as well. Now I just want to point out this year, 2024, is a year of the dragon. So in 12 years ago, the last year of the dragon, 2012, what happened that year? 2012, if you remember, there was a movie called 2012, right? Oh. But that movie was actually made in 2009. But anyway, if you look at that movie, look at the message in that movie. It's more about, you know, when human facing calamities and we work together, we collaborated in that movie and move forward, right? So you have some humans left after the big tsunami. But if you fast forward today, this year's Year of the Dragon, what you are seeing is a lot of conflicts, right? Two conflicts, major conflicts. Back in the last Year of Dragon, there wasn't any national or international conflicts, military conflicts. There was one in Syria, but now we have international conflicts in addition to the US-China contestations that Mr. Heng talked about, whether it's on trade or whether it's on technology. So these are the things that could affect us in our conduct of our business, in terms of cost, right? In terms of supply chain resiliency and risk, right? So these are things we need to watch out for the themes in 2024. And then moving on to the monetary policy decision. So this morning, the US Fed kept interest rate unchanged, and also what is the rate going forward? What kind of policy are we going to see? How about in Singapore? Mr. Heng talked about that this morning. In Singapore, is it going to be data dependent? What kind of numbers can we use to have a sense where things are going, right? Later I'll share with you on that. And then in the China side, this morning also quite a lot of elaboration on China. There's still opportunities, and Chinese government can manage it, and that's our view as well, right? 4.5% growth. Kun Hao talked about that. We expect that, and also I think these risks, the Chinese government have the means to deal with those risks. All right. So electoral landscape, we have two eyes in Asia, right? India, Indonesia. Two eyes in Asia having election. So altogether, just to give you a sense, altogether, 40% of the world population will be in some kind of election this year, 40%. Another estimate is 60% of world GDP will be in some kind of election this year. So the US, India, Indonesia. So there's something to watch out, to keep your, to pay attention to in terms of your supply chain resiliency or risk management, whether it's interest rate, exchange rates, and then the solutions we'll be able to provide you. The bank, we have a lot of colleagues here today, will be able to help you with the solutions with all these potential issues that may crop up, whether it's exchange rate, interest rate, or even supply chain shift, and also the reconfiguration. We will be able to, UOB will be able to provide you with the solutions that Mr. Wee talked about this morning. 2011, we set up this FDI advisory, and that is precisely in this space as well. All the solutions are available, and also opportunities for us. All right, so what would happen in our view? Okay, we expect the US to have some kind of soft landing this year, maybe a bit of soft landing. I'll show you some indicators what to look for. And interest rate cut from the Fed should start in June or so, not so soon yet, not March, but in June. And that will have impact on our Singapore interest rates. Interest rate will probably come down a bit, but may not be as much. I will let Victor talk about that more on the interest rate. And China data is still weak. Show you some indicators, they're still weak. And we have policy support coming in, but not in a big way. Right? The Chinese government, it seems that they are not keen to do all these widespread stimulus measures, wide-ranging stimulus measures, but rather targeted. And that would come in, that is consistent with what DPM said just now about targeted sectors, right? Certain sectors that will provide you with opportunities, because those are the key priority sectors that the Chinese government is paying attention to. All right, so this is the opportunity for us as well, if we can tap onto those. We'll stabilize. And ASEAN, the last piece, the ASEAN, very important for us. It's our neighborhood, and we expect stability this year. After a bit of weakness last year, electronic cycle slowly turning up, so that should help the export sector in Southeast Asia. All right, so I just want, and then FDI flows, very important FDI flows. Still, ASEAN is the number 2, world's second largest FDI destination. So businesses are paying attention, they are putting their money in Southeast Asia, and we want to be part of that as well in terms of opportunities that are coming our way. All right, okay, so US soft landing, why did I say that? Now the charts on the screen are some indicators that a group of people in the US, when they decide whether the US is in recession or not, they look at some of these indicators, right? The NBER, we call that. They look at these indicators, and we want to see what they look at, and then we decide for ourselves or assess how the US economy looks. So these are the 6 major indicators. The red number is the current numbers, right? The current numbers for different areas. For example, personal consumption or spending and real income on the right-hand side here. Employment, non-farm payroll, which tomorrow we'll be getting, the non-farm payroll. And against the backdrop of the past recessions, how are the current numbers compared to past cycle? Now, if you look at all these indicators, most of them actually outperforming, right, against the background, outperforming the past cycles. So it seems that things are still going well for the US, right? All above the average of the past cycles, except industrial production, right? Where the manufacturing sector may not be doing so well. So if there's any weakness, so it could be in the industrial production or manufacturing sector in the US that we want to pay attention to. So in overall, the picture seems to be a more positive picture, and that's the reason why this morning, the Federal Reserve, the decision, they said, oh, the data dependent, right? Mr. Heng said data dependent, data driven, and these are the data driven numbers, right? The picture that they are seeing, and it's very hard for the Fed or the US Federal Reserve to take actions, aggressive actions, or even action at this point. So overall, the picture seems to be pointing to let's say if there's a turn, some numbers are really kind of turning. So if there's a turn, it's a gradual turning sort of a picture that we will be seeing for this year. All right. And also this is just a simple extrapolation from the past. In the past, after the US Federal Reserve paused or stopped the interest rate interest rate hike, there will be a recession that follow some months later. On average, it's about 9 to 17 months. So the last time the Fed stopped interest rate was in July. Right? So if you count from there, whether 9 months or 17 months, that will give you some idea. Maybe first half of this year, there may be some weakness coming in. This is based on past record history. Right? So that's how we assess. We can assess if there's anything that could happen. It will be after the pause, right? The rate pause in July. Let's see how that works out. Just to give you some idea. Now the next data dependent thing is on this messy chart. Very messy. This is the number that the Fed looks at, or this is a kind of number, inflation. This is an inflation situation in the US. When the policy decision comes, they will look at, hey, what's the inflation now? If it's too high, I have to continue or even high, or if it's approaching our target, then we can do something. Now, how do we assess that? Now, every month, you see the US report this inflation CPI in, the next one will be on the 13th, and then there's a PCE, that's another report. There are two reports, PCE, towards the later part of the month. What number should we look at? We can just look at one number, which is a 0 point something number, not the 2% or 3%. It's a month-on-month number. If this month-on-month number is small, then it can move towards a target. So you can see that there's a potential pathways for the inflation to go. So if the number that comes out, for example, the inflation report says at 0.2, for example, then we can project this forward. 0.2, they'll probably hit by end of the year about 2% for the US. So if you project forward. So if the number is very big, for example, in the past, it could be like 1.2% month-on-month. Then it will be at the top. So this is a potential pathway. So the number that we should pay attention to in all this inflation report that comes out is the 0 point something. If it's around 0.1, 0.2, 0.3, or even 0, then the pathway will be pointing down. And that's where the interest rate cut, whether the Fed will do something to lower interest rate, the top will come. If not, if it's on top, then it's very difficult. So the last number was 0.3%. Right, 0.3% month-on-month, so that we need to pay attention. The Fed is not going to do much at this kind of pathway. So that's the reason why this morning the Federal Reserve Chairman Powell said that, we're still data dependent, we'll still look at the data, it's still not the time yet. March is not the time, right? Very explicit. So we put it as June, the next one. All right, those are the US. For China, how does it look? Local government under a lot of pressure. They their income depend a lot on land sales. The land sales revenue is very low. This is for 2023. We look back at the past. It's way below what they have seen in those past years. So rent revenue is less, so you've got to borrow money, right? All this talk about local government debt is there, and that's a risk. And China is quite highly leveraged at this, based on the chart. Total debt is about 300%, close to 300% GDP. Total debt, 300%. Government, corporate, and also consumer, right? Especially the corporate sector. So these are something that leverage, but the Chinese government, like what DPM said this morning, is going through the transformation, reform, restructuring, property market, and all those things to try to moderate it, try to manage it. All right, so these are the things. But the data, the short-term data, are actually looking quite okay. The short-term data, for example, production. We also have trade rebounding. You see, last year, a lot of countries are suffering because the trade is down. So now it's seeing some signs of rebounding. And also, retail sector is still doing okay. Not as good as what they used to have, but still doing okay. The retail sector, consumer spending. So things are actually okay. Now, the last bit I want to touch on is ASEAN. So the China, still opportunity, we're still seeing 4.5%. The last bit is on ASEAN. I just want to touch on what people are looking at. When they look at ASEAN, business people, they put their money. How much are they putting in? The last number, this is a foreign direct investment. When you talk about foreign direct investment, these are the long-term money, not your portfolio, stock market, bond market type. Long-term money. The last number for ASEAN, this is a preliminary number, so about 192 billion. Right, 192 billion inflow into Southeast Asia, the 10 countries. Southeast Asia, then Singapore. By the way, the bulk of it is in Singapore first. It will be about like close to more than 50% parked in Singapore, and then go elsewhere, regional headquarters, treasury center, and all those functions. That's why the money will come first. But other countries also benefit from these inflows. Now, just to give you some perspective, 2012, 2013, the number was about 100 billion inflow into Southeast Asia. It was the number 3 largest in the world. Below China, the blue line, 100 billion. And if you look at the latest, it's already doubled. In 10 years, doubled. And acceleration happened here. US-China tensions and all those things. COVID, the acceleration happened after US-China tensions, right? So this is a supply chain shifts that we witness, and this is showing up in the numbers. So we are the number 2, ASEAN is the number 2 largest destination. So all these businessmen are thinking, I want to diversify, and where should I go? Right? China plus 1 story, China plus N story, and this is where this is happening. So the future, the outlook, the opportunity are still there in Southeast Asia. All right, so this is just a picture of our forecast. China, a bit slow down. Or the world, for the world is about 2.9%, 3%, that sort of number, that sort of growth is not a recession type. It's a bit slow, and nothing, it's not that we should be overly concerned, not as strong, but of course we should not be overly concerned, not a recession. And Southeast Asia, the 6 major economies in Southeast Asia, this year likely to do slightly better. They could do better, but just slightly better, because some of these economies are still having this export-driven model and still trying to recover from last year's slowdown, especially like, for example, Vietnam. All right, so that's a picture for us in the short term. Several things to look out for, monetary policy, interest rate, and also opportunities in China, ASEAN, they're still there. Right, so with interest rate, I want to pass the time to Victor, my colleague, who will tell you more about what should we be looking at for this year. Thanks.
All right.
Thank you. Thank you.
Thanks, Teck In. So when it comes to trying to figure out what monetary policy is going to do, where monetary interest rates are heading in 2024, we essentially try to distill down what our macro team has put up. And we come up with like 2 important inputs. The first takeaway from the macro environment is that inflation is trending lower. In fact, in 2024, we can expect it to get close enough to most central banks' comfort levels, right? So that's an important key point to take away from. The other key point in terms of the thinking about the macro environment is that we are looking at growth slowing down. But essentially, right, the growth slowdown is a non-recessionary growth slowdown, right? So that matters a lot. And that matters a lot when we feed it into our Fed forecast process. The first factor where inflation is trending down. After a couple of years of extremely aggressive monetary policy tightening, the current policy setting is, by our measure, is restrictive. So that with inflation trending towards the Fed's comfort level, that leaves them room to perform what is maybe commonly termed as insurance rate cuts, right? So not an aggressive set of rate cuts, but some insurance rate cuts to take policy from very extremely restrictive setting, right, to somewhere less restrictive. So that's your downward profile, right? We have penciled in the first rate cut from the Fed to take place in the middle of this year. And then the second thing to take away from this chart here is that, and going back to the earlier point on growth, we are looking at non-recessionary growth, which means that your policy makers are not faced with a crisis fighting mode, right? So because there's no crisis currently to fight, then expectations of aggressive rate cuts, not just from the US central banks, but other central banks around the world as well, expectations priced into the market for them to cut aggressively and cut aggressively now is somewhat misplaced in our opinion. So non-recessionary growth means that what you see here, the bottom of our Fed easing cycle, we have the Fed funds settling at around 3.25%. Right? What you'll notice is that this bottom of the cycle is much higher than the last cycle. It's also higher than a 20-some years average, right? The post-millennium average of 1.89, just shy of 2%. So we are saying here that if growth is non-recessionary, we shouldn't expect central banks to be in a crisis-fighting mode. Rate easing will come because your inflation targets are hit. But at the same time, do expect that the reasonable scenario is that your Fed funds might settle at a higher level than what we've previously experienced. So that's the picture with the overnight policy rate. So as the policy rates we enter into an easing cycle, tenors throughout the curve, right? So if you're talking about 3 months, 2 years, 10 years, right? Those yields are going to come down as well, because we are in an easing cycle. But there will be stumbling blocks along the way. Nothing comes down in a straight line, right? So we want to highlight one of these possible stumble blocks, right? Essentially, it's the deficit, the US government's deficit. And by our measure, this year's government deficit, or the need for the US government to come into the market and borrow more money, that is about on average, 20-some% increase over 2023. So with more supply coming in, the problem is that over the last year or so, your buyer profile has actually shifted. It's shifted from a price-insensitive buyer, meaning the Fed, right? Because the Fed has been expanding its balance sheet, but over the last couple of years, it's been running down its balance sheet. So it's not buying as much, but it is a price-insensitive buyer. This buying profile has shifted towards your domestic and household sectors in the US, which are, by definition, more price-sensitive. So it may come to pass that we could encounter issues with supply, and it definitely needs to clear, but the yields could be pushed up higher during those periods. We've seen this happen not too long ago, back in October, and it could happen again in this year. So that's something to take note of. Yes, monetary policy easing means that rates are coming down overall, but it's not likely to go in a straight line. There will be a few speed bumps along the way. One of this to take note of could be the supply argument. And this also, because it's supply, it could affect more of your longer tenors. So if you're looking at the 10-year portion of the curve or the 30-year portion of the curve, this could come into play more specifically in those sectors. And so if we take supply, possible speed bumps, Fed easing at the very front end, it means that our view on the yield curve, right? We've gone through a fairly unusual past couple of years where your 2-year interest rate is much higher than your 10-year interest rate, right? You can see here from the history that it's fairly unusual. And I would say that with our monetary policy expectations, this era is coming to an end, right? So we expect this yield curve to normalize. Perhaps as early as June, we'll get a slightly positive sloping yield curve, meaning that the 2-year yield is back down lower than the 10-year yield. Right? And this process will continue through the whole cycle of monetary policy easing. So yield curves are going to steepen back into something more of a normal situation. Shifting our view away from the US and then more broadly into across the world, right? You can see here a few things, right? First, if we focus in on the developed markets, so most developed markets are expected to cut rates alongside the US. The only exception here is Japan, who is dancing to its own tune. We expect the BOJ to normalize monetary policy, but monetary policy normalization in Japan will be quite limited at the get-go. We're not projecting a multiple series of rate hikes from the BOJ. So that's the developed market space, more or less following along with the US Fed in terms of easing policy rates there. I think the main sort of divergence or the main key thing to pick out here, if you compare developed markets and us closer to home here in Asia, is that we have quite a number of Asian central banks who can adopt a wait-and-see attitude, right? The argument here is really twofold. First is that most of the problems faced in terms of growth slowdown is also an external demand issue, right? So with the developed central banks cutting rates already, naturally you expect some support coming in. So external demand may be supported in the midst of rate easing from developed markets. So Asian central banks could afford to sort of sit back and see what sort of boost eventually flows through into their external demand before deciding on whether to pull their own domestic levers or not. The second reason here is because the US Fed has hiked rates so aggressively in this rate hike cycle that interest rate differentials, right, between the emerging world versus the US is very, very tight. So letting the developed market central banks do the heavy lifting, normalize interest rate differential, ought to provide some support to the currency, to domestic currencies, right? So your EM currencies. This more supported EM currencies would feed through naturally into confidence, which is not a bad thing. And at least at the initial phases, we can see that the Asian central banks might be more open to that idea of interest rate differentials sort of widening back out again. So that's the takeaway, right? Developed markets mostly following along with the US. Asia-wise, we look for a bit of a wait-and-see approach in terms of monetary policy easing. And finally, we get to the Sing rates, right? Coming back home. And you can see that over the long history, Singapore interest rates is a close cousin of the US interest rates. And going forward, we don't expect this relationship to change. We will expect Sing interest rates to head lower as well because the Fed is cutting rates. But how much we adjust for every adjustment that the US rates take will depend on the performance of our currency, the Singapore dollar, right? And the performance of the currency essentially ties back to our expectations surrounding MAS policy, which is where I'll now hand off to Peter, where he will talk more on our FX forecasts and expectations. Thank you.
Okay, thanks, Victor. I always joke with my colleagues that I always got the easiest job in the last couple of years. The easiest, why? Because this cycle is a rates-driven FX cycle. Never have we seen the US dollar follow so closely to interest rate expectation to move in the US Treasury yields. So as you can see, just if you have missed out what happened in the last 2 years, those are very difficult years for business owners. We grapple with high interest rate, and because of high interest rate, it brings the dollar higher. But I think the good thing that happened last year, or the good takeaway, is that dollar sort of consolidated because interest rates in US are no longer rising. So that's the reason why I said I got the easiest job. So going forward, what do we see this year? As what Victor alluded to, we are looking for rate cuts. So typically rate cuts will bring US interest rates lower, the Treasury yield curve lower, and because of that, we are forecasting the dollar index to go lower. If you ask me, is it a lot being priced in the market? I'll say not really a lot has been priced in, because if you look at where this dollar rally started, it started at about 90 for dollar index. So if our projection for dollar index towards 98 by the end of the year, I don't think it's very far-fetched. And at the same time, there are fundamental reasons behind our expected decline in the dollar. I think one of the main reasons is because if you remember last year, everyone talks about a king dollar because US economy is very strong, growing about over 3%. This year is going to be totally different. US is struggling with a technical recession, and it's likely to post growth of just 1%. So the king dollar debate is no longer relevant, and because of that, data is no longer supporting the strength of the dollar, and so the dollar naturally should drop. And another important reason, which Victor also mentioned a little bit on, was the Fed is going to take leadership on the downside in cutting rates as well. You've seen that we're expecting the US to cut more than the rest of the other central banks. So because of that, the US dollar advantage over its peers is going to start to shrink, and that itself also brings the dollar lower. But this is a volatility chart. It tells you the volatility of the US dollar so far. And I think, firstly, let's see where it is right now. It is fairly low if you look at the last couple of years. There is a close correlation with the dollar strength or weakness with volatility. Typically, it's positively correlated. It means that when the dollar is strong, it brings volatility higher. When the dollar is weak, usually, or expected to be weak, the volatility also stays low. So this low volatility adds conviction to our expectation that the dollar decline will still continue to happen. But at the same time, it brings another positive message. Because when the volatility is low, corporates like yourself can afford to hedge in the FX market at slightly lower cost. So you've been waiting to hedge against on the dollar. I think the cost is something that you can look at in the coming months because it's still leaning on the low side. So what is our best bets in the FX market right now, or our best view about the FX market going forward? In the developed space, we think that there's a good chance that the yen will outperform this year. We have expected the yen to outperform last year. It didn't really happen because the Bank of Japan disappointed everyone by dragging their feet through thinking about when to tighten. But I think by now, I think it's quite clear that they have to tighten. If you have been to Japan in the last couple of months, I think half of Singapore is in Japan in December, right? So you will notice that inflation is really taking place in Japan. The ramen is no longer at 900 yen, it's higher than that. There's wage growth finally for the first time in Japan for over 30 years. So inflation is up. Bank of Japan have to act, and we think that because of not only they will tighten interest rate, it will be a monumental move because for the longest time, interest rate in Japan is in negative territory. They will move it up to zero, so ending this whole era of negative interest rate once and for all, sometime in the middle of this year. And when that happens, it typically brings alongside the yen to strengthen. And if you look at the price of the yen, I mean, to use a very simple word, it is dirt cheap. So it is quite easy to expect it to strengthen after two very weak performance in the last 2 years. So moving our eyes from developed space into Asian currencies. There's a good saying, whenever China catch a cold, when China sneezes, the whole region catches a cold. So in the currency market, it's also the same trend. So let me help you orientate. The red line is dollar China over the last couple of years. You can see the other lines, dollar Asia, broadly follow the dollar China trend. So for me to forecast Asian currencies, I must understand China really well. Yeah, so you heard a lot of negative news about China in the last 1 month or so. But I look at the price alone. Dollar China, do you know that it only moved up 1%, meaning the renminbi weakened 1%, while the equity market was like 10, 20% volatility. And in the whole Asian currency space, the renminbi depreciated the least against the US dollar. So this is telling me that the FX market is not as negative as a stock market on the renminbi and on China economy as its own. So we are just waiting for the moment for it to turn. And we think that this year, the moment for it to turn could be US finally cutting interest rate, and the dollar weakness will eventually cause the turn in the whole dollar Asia space in favor of Asian currency. And just to fun fact only, in all dragon years, it has been seen to deliver positive, stable returns both in China equities and, more importantly, the renminbi. So let's see how it plays out this year. Okay, but dwelling a little, so if the renminbi is stabilized and eventually move stronger, it typically brings the rest of the Asia space. So just to give some time to some of the different currencies. I think Thai baht, there's a good chance Thai baht is a black line, so it has depreciated, underperformed for the last 2-3 years. I think there's a good chance about the revival of tourism. They are at the final leg of this tourism revival. I think if you have been to Thailand in the last 1 month or so, you know that the airport is getting a lot more busier, you're getting longer queues. So these are all signs that the movement is there. So there's a good chance that Thai baht could be a surprise outperformer this year. Indonesia, I think in the near term, there's going to be a little bit of political uncertainty as they step through the elections, but eventually it will catch up with the rest of the Asian trend. Ringgit is a double-edged sword in a way that it follows the RMB too closely. So last year was really bad. I mean, it's good for Singaporeans in a way that because the Sing Ringgit is hitting record, right? So we're going across the causeway. But at the same time, because it's double-edged sword, if we expect the red line or the renminbi to recover, it means that the ringgit can also recover maybe in a bigger way this year. So don't totally write off the ringgit this year, given what we've seen last year. So there could be some silver linings to look out for Asian currencies. In Singapore, I think there's something at least interesting to me that I think as an FX strategist, I thought this could be a big story for this year, that it's going to be a convergence story. So industry that did very well in the last 2-3 years, that means the internal facing industry, consumer facing industry like your tourism, your F&B, may start to moderate because this tailwind of the post-COVID recovery recedes. And at the same time, industry that did very badly last couple of years, like the external facing industry, may start to reverse because we are getting clear signs that we are getting production, exports growth, semiconductor cycle all bottoming and turning about. So this could be the driving force for this convergence. But nonetheless, I think we are positive on the Singapore economy. It's going to be a better year compared to last year. Last year was 1.2. We are looking for 2.9 this year. On inflation, I think it's also following the rest of the world, very healthy trend normalizing towards the medium or the target which the government wants. But near term, I think there is a fair bit of administrative measure that keeps inflation elevated, including the GST pass-through, and also maybe the upcoming water tariff, electricity tariff, and also the more structural carbon tax that will eventually keep at least inflation slightly entrenched in the first quarter or so, but eventually we are seeing this trend to continue. So it leads to the bigger discussion, what MAS will react to that. So just now, Mr. Heng was saying that it's similar to the MAS and the government, we adopt a data-dependent model, and at the same time, we have something very in our arsenal, which is called a crystal ball. So we think what we have for the data will come out in the future. We put in our crystal ball. We think that inflation will continue to go down. So that one is one of the reasons why it adds confidence for the MAS to ease, or rather not tighten the Singapore dollar so much. So that's one. And the other one is because our output gap is slightly assessed to be slightly negative. So that could be another reason giving the MAS to also reduce the policy slope somewhat. So we're expecting a move in April. So I don't know whether we'll get it right. But yeah, so what does it mean? It means that the Sing dollar will not be so strong relative to our peers. Yeah, so what it means is that our Sing Ringgit, our Sing CNY may start to normalize a little bit lower after the very strong move that you've seen in the last 2 years. The last and foremost chart I think you have been waiting for, what do you think about dollar Sing? As simple as that, I think we're at 134 right now. There is scope because of the dollar decline. I think we can go towards 130, but it's nothing going to be very fanciful about because it's just a 2% gain. But I think at 130, I think this has to be a very clearly defined floor for dollar Sing for a while. I don't think we have enough factors arguing for a lot of weakness for the dollar if we are just factoring just 3 rate cuts for the Fed. So that's it for me. I hope you enjoy our presentations, and I hope you look forward to the next presentation. Thank you.
Thanks, Peter. Let me wrap up. Just in case you didn't get what Peter said just now, you know, you were on the phone or something like that. So very important, dollar Sing going to come down. but not going to be as fast. So you're going to watch yen could strengthen, right? Yen strengthening, and then you know what to do. Call your FX, your corporate sales, and tell them, and also for your own personal holidays, right? So I'll start with this. So King dollar is going to weaken because of the interest rates, but Asian FX. So watch our dollar CNY, right? May normalize a bit, may not be as strong, and also ringgit. Don't write off ringgit. Peter mentioned to you just now. So take that into account in your planning for this year. And also MAS policy in April, we expect some loosening because of the negative output gap and also inflation moving towards towards the target that the government has set, the MES has set. And then in terms of interest rates, watch out on that. There'll be some rate cuts, but it's likely to be higher for longer, right? I think that's the message here, higher for longer. Regional central banks may not move that much. So again, take into account of your planning for the regional business, for your business in the region. And because of the non-recessionary growth, the US may not have to do much on that part. Right now, yield curve steepening, back to a steepening curve rather than an inversion by middle of this year. So that one also another thing to watch. And again, on the part that I presented earlier, I think this US soft landing may be another reason why the Fed may not be aggressive, and the higher for longer, and that's where the rate picture comes in. And also China, there's still opportunity there. They can manage the situation. They have experience handling that. So they have the means, they have the tools to manage. So we expect some slow growth in China, 4.5%. Nothing fanciful, nothing great, but still, I think there's still enough, I think, for businesses to take advantage of, to capitalize on. And regionalization trends will continue. With all the talk about this morning on supply chain diversification, your risk management, your China Plus One, that will benefit us in Southeast Asia in many areas. So our companies, our businesses here to take advantage, capitalize on that trends, ride on it, and make money out of it, right? Okay, with that, thank you very much for your attention, and my colleagues as well, Peter and Victor, for the excellent presentation. Thank you.